You know, I turned 95 years old in 2025. I've been investing for more than 8 decades now. And one of the questions I get asked most frequently, particularly from people in their 60s and 70s, is how they should think about protecting their portfolios as they enter retirement. It's a different question than what to buy when you're young and accumulating wealth. The priorities shift, the risks change, the strategies need to adapt. When you're over 60, you're playing a different game than you played in your 30s or 40s. You're no longer in the accumulation phase where your primary goal is growth. You're transitioning into preservation and distribution. You need your portfolio to generate income. You need to protect against catastrophic losses because you don't have decades to recover. And you need to make your money last for what could be 20, 30, or even 40 more years given modern life expectancies. But here's the thing that most people get wrong. Portfolio protection for retirees doesn't mean going 100% into bonds and cash and avoiding all risk. That's actually one of the most dangerous strategies you can follow. Why? Because inflation will slowly but surely erode your purchasing power over what could be decades of retirement. If you're 65 today, you might live to 90 or 95. That's 30 years of inflation eating away at the value of fixed income investments. So if someone came to me today and said, Warren, I'm 65 years old, I have $500,000 saved for retirement. How would you protect my portfolio in 2026 and beyond? I'd have very specific advice. It wouldn't be the same advice I'd give to a 30-year-old, but it also wouldn't be overly conservative advice that sacrifices long-term security for short-term stability. Let me start with the most important principle for retirees. You need to maintain significant equity exposure. Even in retirement, I know this goes against what many financial advisors tell you. The old rule of thumb was to subtract your age from 100 to determine your stock allocation. By that logic, a 65-year-old should have 35% in stocks and 65% in bonds. That might have made sense when bond yields were 8 or 10% and life expectancies were shorter. But in today's world, it's a recipe for running out of money. Here's why stocks remain essential even after 60. First, retirement potentially lasts 3 decades or more. That's a long time horizon. You need growth to offset inflation over that period. If you're living on fixed income from bonds, your purchasing power will decline every year. What costs $100,000 today might cost $200,000 in 20 years at 3% inflation. Your fixed bond income won't keep pace. Second, stocks provide inflation protection that bonds don't. Good businesses can raise prices when costs increase. Their nominal earnings grow with inflation. Over long periods, stock prices follow earnings higher. This makes stocks a natural inflation hedge, albeit an imperfect one in the short run. Third, the current yield on bonds is barely above inflation. 10-year treasuries yield around 4.5%. With inflation running around 3%, your real return is 1.5%. That's not enough to maintain purchasing power when you're withdrawing money for living expenses. You need higher returns, and that means owning stocks. So here's how I'd structure a portfolio for someone over 60 in 2026. I'd allocate 50 to 60% to stocks, 30 to 40% to bonds and cash, and the rest to other assets depending on individual circumstances. This is more aggressive than conventional wisdom suggests, but I think it's necessary given low bond yields, high life expectancies, and the reality of inflation. But not just any stocks. The equity portion needs to be thoughtfully constructed with an emphasis on quality, stability, and income. This isn't the time to be swinging for the fences with speculative growth stocks. You need businesses that will keep generating cash flows and dividends regardless of economic conditions. My first building block would be high-quality dividend-paying stocks. Companies that have paid and raised dividends for decades consecutively. These are often called dividend aristocrats. Companies that have increased dividends for 25 straight years or more. Think Johnson & Johnson, Procter & Gamble, Coca-Cola, PepsiCo, McDonald's, Walmart, 3M, Colgate, Palmolive. These are established businesses with proven staying power. Why focus on dividend stocks for retirees? Several reasons. First, dividends provide income you can live on without selling shares. If you own stocks yielding 3% and you have $500,000 invested, that's $15,000 in annual dividend income. That supplements Social Security and other retirement income without depleting your principal. Second, dividend-paying companies tend to be more stable than non-dividend payers. Companies that commit to paying regular dividends are typically mature, profitable businesses with strong cash flow. They're less likely to be speculative ventures that could blow up. That stability is valuable when you can't afford big losses. Third, dividend growth provides inflation protection. A good dividend stock doesn't just pay 3% today, it raises that dividend every year. Johnson & Johnson has raised its dividend for 62 consecutive years. Over time, your dividend income grows and helps you keep pace with inflation. A 3% yield today might become a 6% yield on your original cost in 10 or 15 years as the company raises dividends. Fourth, dividends are psychologically comforting during market downturns. When stock prices fall and your portfolio value declines, seeing those dividend checks still arrive every quarter provides reassurance. The business is still operating, still generating cash, still returning money to shareholders. That psychological comfort helps retirees avoid panicking and selling at the worst possible time. I'd allocate maybe 25 to 30% of the total portfolio to high-quality dividend stocks. Not one or two companies, but a diversified basket of 10 to 15 businesses across different sectors. Healthcare, consumer staples, industrials, utilities, financials. This provides diversification while maintaining the focus on income and stability. The second building block for the equity portion would be index funds, specifically an S&P 500 index fund. I'd put another 20 to 25% of the total portfolio here. This gives broad exposure to the largest U.S. companies without having to pick individual stocks. It's lower maintenance than owning individual equities and provides instant diversification across 500 companies. The index fund portion serves a different purpose than the dividend stocks. It's your growth engine. While dividend stocks provide income and stability, the index fund participates more fully in market gains during good times. Some of the biggest companies in the S&P 500, like Apple, Microsoft, Google, and Amazon, pay modest dividends but generate substantial capital appreciation over time. For a retiree, having this dual approach makes sense. The dividend stocks provide income you can count on. The index fund provides growth potential to offset inflation and build wealth over the long term. Together, they create a balanced equity portfolio that addresses both current income needs and long-term purchasing power preservation. Now let's talk about the bond portion of the portfolio, which I'd allocate 30 to 40% depending on the individual's risk tolerance and other income sources. Bonds serve several important functions for retirees. They provide stable income, they reduce overall portfolio volatility, and they act as a buffer during stock market crashes, giving you assets to sell for living expenses without having to liquidate stocks at depressed prices. But not all bonds are created equal, and I'd be very specific about what types to own. I would not buy long-term bonds, 30-year treasuries or long-term corporate bonds. Why? Because long-term bonds are extremely sensitive to interest rate changes. If rates rise 2 or 3 percentage points, the market value of long-term bonds can fall 25 or 30%. That's not the stability you're looking for in the bond portion of your portfolio. Instead, I'd focus on short to intermediate term bonds with maturities of 1 to 7 years. These provide decent yields while limiting interest rate risk. If rates rise, yes, the value of your bonds will fall, but they'll mature relatively soon and you can reinvest at the new higher rates. You're not locked into low rates for decades the way you are with long-term bonds. I'd split the bond allocation between treasury bonds for safety and investment-grade corporate bonds for slightly higher yields. Maybe 60% treasuries, 40% high-quality corporate bonds from companies like Microsoft, Johnson & Johnson, and Walmart. These companies aren't going bankrupt. Their bonds are extremely safe, and they pay a bit more than treasuries, maybe an extra 50 to 100 basis points. The bond portfolio should be structured as a ladder with bonds maturing every year or two. This provides regular cash flow and reduces reinvestment risk. As each bond matures, you can assess interest rates at that time and decide whether to buy new bonds or shift money into stocks if they're attractively priced. One option I particularly like for retirees is building a bond ladder specifically designed to cover 5 years of living expenses. Here's how it works. Calculate how much money you need to withdraw from your portfolio annually to cover expenses not met by Social Security or pensions. Multiply that by 5. That's how much you allocate to a bond ladder with 1/5 maturing each year for the next 5 years. This gives you 5 years of spending money in stable, predictable assets. You can cover your expenses for 5 years without touching your stocks. That psychological security is enormous. When the next bear market hits and stocks fall 30 or 40%, you don't have to sell equities at depressed prices. You just live off your maturing bonds and wait for stocks to recover. As each year passes and a portion of the ladder matures, you replenish it from dividend income, new bond purchases, or by selling stocks if they're at favorable prices. The systematic approach removes emotion and panic from the withdrawal process. Now let's talk about cash, which I'd keep at about 5 to 10% of the portfolio. This is your emergency fund and your opportunity fund. It sits in money market accounts or short-term treasury bills earning 4 to 5% in the current environment. That's not exciting, but it serves important purposes. The emergency fund portion covers unexpected expenses, medical bills, home repairs, helping a family member in need, whatever comes up. Having liquid cash means you don't have to sell stocks or bonds at inopportune times to cover emergencies. For a $500,000 portfolio, $25,000 to $50,000 in cash provides meaningful security. The opportunity fund portion is money you can deploy if stocks crash and create buying opportunities. If the market falls 30% and dividend yields on quality stocks spike to 5 or 6%, you can use your cash to buy more. This turns market crashes from disasters into opportunities. Some financial advisors argue that holding cash is a drag on returns because it earns less than stocks or bonds. That's true in normal times. But retirees aren't optimizing purely for returns. They're optimizing for security and flexibility. The peace of mind from having cash available is worth the modest return sacrifice. Let me talk about what I would not own in a retirement portfolio. First, no speculative growth stocks. Companies trading at 50 or 100 times earnings with no profits. Businesses that might change the world but might also go to zero. Electric vehicle startups, biotech companies with drugs in development, unprofitable tech companies. These might be fine for a small portion of a young person's portfolio. For a retiree, absolutely not. The risk reward is all wrong. If you bet on a speculative stock and you're right, maybe you double or triple your money. Great. But if you're wrong, you could lose 50, 75, or 100%. A 65-year-old can't afford to lose half their portfolio on bad speculations. The upside doesn't justify the downside risk. Second, no cryptocurrency. I know some people think crypto is the future and everyone should own some. I disagree, especially for retirees. Crypto produces no cash flows. It has no intrinsic value. Its price is based purely on what someone else will pay for it tomorrow. That's not investing. That's speculation. And it's wildly volatile, routinely falling 50 to 70%, even in relatively calm years. A retiree needs their money to be there when they need it. They can't afford to see their Bitcoin fall from $50,000 to $20,000 right when they need to withdraw money for living expenses. Stick with productive assets that generate earnings and cash flows. Third, no complex derivatives or leveraged products. No options, no futures, no inverse ETFs, no leveraged ETFs. These are trading tools, not investment vehicles. They're designed for sophisticated traders trying to make short-term bets. The fees are high, the risks are substantial, and they're completely inappropriate for retirees trying to preserve wealth. Fourth, minimize exposure to high-cost, actively managed mutual funds. If you're paying 1 to 2% in annual fees, you're giving away 20 to 40% of your potential returns over a 20-year retirement. That's wealth that should be in your pocket going to fund managers who statistically probably won't beat index funds anyway. Stick with low-cost index funds or individual stocks and bonds where you pay minimal fees. Now let me talk about withdrawal strategies, because how you take money out of your portfolio is just as important as how you allocate it. The traditional rule is the 4% rule. Withdraw 4% of your portfolio in the first year of retirement, then increase that dollar amount by inflation each year. So on a $500,000 portfolio, you'd withdraw $20,000 in year one, then adjust that for inflation going forward. The 4% rule is based on historical analysis showing that this withdrawal rate had a high probability of not depleting your portfolio over 30 years. But I think it's too simplistic for real-world application. Here's why. Markets don't return steady amounts every year. Some years you're up 30%, some years you're down 20%. Mechanically withdrawing the same inflation-adjusted amount regardless of market conditions can be problematic. If you retire right before a major bear market, what academics call sequence of returns risk, withdrawing 4% while your portfolio is declining can deplete your assets faster than expected. You're selling shares at low prices to fund withdrawals, permanently reducing your asset base just when you need those shares to recover in value. My preferred approach is flexible withdrawals based on market conditions and portfolio performance. In good years when your portfolio is up, you can withdraw a bit more, maybe 4.5 or 5%, splurge a little, take that trip you've been wanting. In bad years when markets are down, tighten your belt and withdraw less, maybe 3 to 3.5%. Spend less on discretionary items, delay major purchases. This flexibility dramatically increases the probability that your portfolio lasts throughout retirement. You're not rigidly depleting assets during downturns. You're giving your portfolio room to recover. And in exchange for a bit of spending flexibility, you get much better long-term financial security. Another strategy I like is to live primarily off dividend income and avoid selling shares as much as possible. If your 50 to 60% equity allocation yields 3% on average, that's $15,000 to $18,000 per year on a $500,000 portfolio. Add in Social Security, maybe a pension, and many retirees can cover most expenses without touching principal. This approach has several advantages. First, you're not depleting your asset base, so your portfolio can keep growing. Second, dividend income tends to be stable and often grows over time, providing inflation protection. Third, psychologically, it's easier to spend income than to sell shares. You don't feel like you're eating into your nest egg. Of course, this requires having enough dividends plus Social Security and other income to cover expenses. If there's a gap, you need to sell something. But the goal is to minimize those sales and let compound growth do as much heavy lifting as possible. Let me talk about tax efficiency in retirement, because this is an area where you can save enormous amounts of money with smart planning. If you have money in multiple account types like traditional IRAs, Roth IRAs, taxable brokerage accounts, and maybe an HSA, you need a withdrawal strategy that minimizes lifetime taxes. The general principle is to fill up your lower tax brackets with withdrawals from tax-deferred accounts like traditional IRAs, where withdrawals are taxed as ordinary income. Once you hit higher brackets, switch to taxable accounts where you pay lower capital gains rates. And save Roth IRA withdrawals for last because they're tax-free and you want that money compounding as long as possible. For example, if you're married filing jointly, you might withdraw enough from your traditional IRA to fill up the 12% tax bracket, around $90,000 of taxable income in 2025. Then take additional money needed from taxable accounts where long-term capital gains are taxed at 0 or 15% lower than the ordinary income rate you'd pay on IRA withdrawals. You also need to think about required minimum distributions, which start at age 73 under current law. Once RMDs kick in, you're forced to withdraw a percentage of your traditional IRA and pay taxes on it whether you need the money or not. This can push you into higher tax brackets and increase your Medicare premiums. One strategy is to do Roth conversions in your early 60s before RMDs start. You convert some money from your traditional IRA to a Roth, paying taxes now at hopefully lower rates, and then that money grows tax-free forever and doesn't count toward RMDs. This requires careful analysis because you're voluntarily paying taxes today to save taxes in the future. But for many retirees, it makes sense. Another consideration is location of assets. High-yield bonds and REITs that generate ordinary income should go in tax-deferred accounts where that income isn't currently taxable. Stocks that generate long-term capital gains should go in taxable accounts where they get preferential tax treatment. Tax-efficient index funds can go anywhere but are especially good in taxable accounts because they don't generate much in taxable distributions. Now, let me talk about healthcare, which is often the biggest wild card in retirement planning. Medical expenses increase with age. Medicare covers a lot, but not everything. Long-term care costs can be astronomical. A single year in a nursing home can cost $100,000 or more. These expenses can devastate a retirement portfolio if you're not prepared. My view is that you need to budget realistically for healthcare expenses. The conventional estimate is that a couple retiring at 65 will spend about $300,000 on healthcare over their retirement. That's for premiums, deductibles, copays, and uncovered services. It doesn't include potential long-term care, which could add hundreds of thousands more. One option is long-term care insurance, though it's expensive and comes with restrictions. Another is to self-insure by maintaining a larger portfolio and accepting that a significant portion might go to health care. A third option is hybrid insurance products that combine life insurance with long-term care benefits. There's no perfect answer, but you need to acknowledge that. Healthcare expenses will be substantial and plan accordingly. This is another reason why maintaining equity exposure is important. You need growth to cover potentially decades of increasing medical costs. Let me address Social Security claiming strategies, because when you claim makes a huge difference in lifetime benefits. You can claim as early as 62, but your benefit is permanently reduced by about 30% compared to claiming at full retirement age of 67. If you wait until 70, your benefit increases by about 24% compared to age 67. The break-even analysis depends on life expectancy, but for many people, delaying Social Security until 70 makes sense if you can afford to wait. The higher benefit lasts your entire life and provides better inflation protection. It's essentially buying an inflation-adjusted annuity with an 8% guaranteed return by delaying from 67 to 70. You can't get that return anywhere else risk-free. The strategy I often recommend is to use portfolio withdrawals to cover living expenses from 65 to 70, letting Social Security grow. Then at 70, claim the maximized benefit and potentially reduce portfolio withdrawals since your Social Security income is higher. This requires having sufficient portfolio assets to fund those early years, but it optimizes lifetime income for many retirees. For married couples, the analysis gets more complex because of survivor benefits. Generally, the higher earner should delay until 70 because that determines the survivor benefit for the remaining spouse. The lower earner might claim earlier. But every situation is different and requires careful analysis. Now let's talk about rebalancing, which is crucial for maintaining your target allocation over time. If you start with 60% stocks and 40% bonds, after a strong bull market, you might find yourself at 75% stocks and 25% bonds. That's more risk than you intended. Conversely, after a crash, you might be at 45% stocks and 55% bonds, missing out on the recovery. I'd recommend rebalancing at least annually, maybe more frequently if allocations drift significantly. The discipline of rebalancing forces you to sell high and buy low. When stocks have run up and represent a larger portion of your portfolio, you sell some and buy bonds. When stocks have crashed and fallen below your target, you sell bonds and buy stocks. This is psychologically difficult but financially beneficial. One elegant way to rebalance is to direct all dividend income and bond interest to whichever asset class is below target. If stocks have fallen and you're underweight equities, reinvest all income into stocks until you're back to target. This accomplishes rebalancing without generating taxable sales. Let me talk about the biggest psychological challenge retirees face, dealing with market volatility when you're drawing down assets. It's one thing to hold through a crash when you're young and accumulating. You tell yourself it's a buying opportunity and stay calm. But when you're retired and withdrawing money, watching your nest egg decline 30% is terrifying. The key is preparation. Before the crash happens, before you retire, game out the scenario. Visualize your portfolio falling from $500,000 to $350,000. Imagine how you'd feel. Think through your response. Commit in advance to not panic selling. Remind yourself that you have your bond ladder covering 5 years of expenses. You don't need to sell stocks for years. You can wait for recovery. Also remember that your dividend income likely continues even when stock prices fall. If you own Johnson & Johnson or Procter & Gamble, they'll keep paying dividends through recessions. Your cash flow doesn't disappear even if your account balance temporarily declines. Focus on the income, not the account value. Another helpful psychological trick is to not check your portfolio constantly. There's no need to monitor your balance daily or even weekly. Check it quarterly when you rebalance. Otherwise, ignore it. The more frequently you look, the more volatility you'll see, and the more tempted you'll be to make emotional decisions. Let me address inflation more directly because it's such a critical risk for retirees. At 3% annual inflation, prices double every 24 years. If you retire at 65 and live to 90, you'll experience near doubling of prices. What costs $50,000 per year today will cost nearly $100,000 in 25 years. If your income is fixed, whether from bonds or annuities that don't adjust for inflation, your standard of living will decline by half over that period. You'll be forced to cut spending dramatically or risk running out of money. This is why Social Security's inflation adjustment is so valuable. It ensures your purchasing power remains relatively stable. For portfolio assets, the inflation hedge comes from stocks with pricing power. Companies that can raise prices at least in line with inflation without losing customers. Coca-Cola, Procter & Gamble, utilities, railroads. These businesses pass inflation through to consumers, maintaining real earnings and ultimately real stock values. Treasury inflation-protected securities, TIPS, are another option. These bonds adjust principal and interest payments based on inflation, providing direct inflation protection. The downside is they yield less than regular treasuries, and in low inflation environments, they underperform. But for retirees very concerned about inflation risk, allocating some of the bond portion to TIPS makes sense. Let me close with a realistic example of how this all might work. Suppose you're 65 with $500,000 saved for retirement. Social Security will provide $30,000 per year starting at age 70. You need $50,000 annually to live comfortably before Social Security, then $20,000 annually after. Here's how I'd structure it. Put 60% or $300,000 into stocks. Half in high-quality dividend payers yielding 3%, half in an S&P 500 index fund yielding 1.5%. That's about $6,000 in annual dividend income. Put 35% or $175,000 into a bond ladder designed to cover 5 years of pre-Social Security living expenses. $25,000 per year times 5 years equals $125,000, leaving $50,000 in intermediate bonds for flexibility. Put 5% or $25,000 into cash for emergencies and opportunities. In the first 5 years before Social Security, you live off the maturing bonds, supplemented by $6,000 in dividends, covering $50,000 in annual expenses. At age 70, Social Security kicks in at $30,000 per year. Now you only need $20,000 from your portfolio. Your $6,000 in dividends plus $14,000 from bond interest or strategic stock sales covers that easily. Meanwhile, your $300,000 in stocks has hopefully grown. At 7% annual growth, which is conservative, it might be worth $420,000 by age 70. Now that larger base generates more dividend income, and you have decades for it to keep compounding. This approach provides income security through the bond ladder, growth potential through stocks, and flexibility through cash reserves. It's not perfectly safe. Stocks could crash right after you retire. Inflation could spike higher than expected, but it balances the various risks better than being too conservative with bonds or too aggressive with growth stocks. The key principles: maintain meaningful equity exposure for growth and inflation protection, build a bond ladder for near-term spending, security, keep some cash for flexibility, focus on quality dividend-paying stocks, minimize fees and taxes, and be flexible with spending based on market conditions.
Follow those principles, and you dramatically increase the odds of your money lasting throughout a long retirement.
Now let me talk about estate planning, because once you're over 60, you need to think seriously about what happens to your wealth when you're gone. I've spent considerable time thinking about how to pass on wealth to my children and to charity in a way that's both tax efficient and aligned with my values. Even if your estate is much smaller than mine, the principles apply. First, make sure you have a will. It's shocking how many people reach their 60s without a proper will. If you die without one, the state decides how your assets get distributed according to intestacy laws. That might not align with your wishes at all. A will lets you control who gets what, name guardians for minor children or dependents, and specify your funeral preferences. It's not complicated or expensive to set up. Just do it. Second, consider a trust for larger estates. If you have substantial assets, trusts can provide control, privacy, and tax benefits that wills don't offer. A revocable living trust avoids probate, keeping your estate private and speeding up distribution to heirs. An irrevocable trust can remove assets from your taxable estate, potentially saving enormous amounts in estate taxes for wealthy individuals. Third, review your beneficiary designations on retirement accounts and insurance policies. These override your will. I've seen cases where someone divorced, remarried, but never updated their IRA beneficiary designation. When they died, the ex-spouse got the IRA instead of the current spouse because the beneficiary form was never changed. Check these annually and update them whenever your life circumstances change. Fourth, think about Roth conversions as part of estate planning. When you leave a traditional IRA to heirs, they'll pay income tax on distributions. But if you convert to a Roth and pay the taxes yourself, you're essentially giving them a tax-free inheritance. This is especially valuable if you're in a lower tax bracket than your heirs will be. You pay taxes at your rate, they inherit tax-free money. Fifth, understand the step-up and basis rules for taxable accounts. When you die, your heirs get a step-up in cost basis to the fair market value on your date of death. This eliminates all capital gains tax on appreciation during your lifetime. If you bought stock for $10,000 and it's worth $100,000 when you die, your heirs can sell immediately and owe no capital gains tax. This is one of the greatest tax benefits in the code. This step-up rule has implications for tax planning. It often makes sense to hold highly appreciated stocks until death rather than selling and realizing gains. Let your heirs get the step-up and sell tax-free if they want. Of course, this needs to be balanced against portfolio concentration risk and diversification needs, but the tax benefit is real. Charitable giving is another important consideration for people over 60 with substantial assets. I've pledged to give away more than 99% of my wealth to charity. Obviously, most people aren't in that position, but even modest charitable giving can be tax efficient and personally fulfilling. One of the best strategies is donating appreciated stock directly to charity. Suppose you have stock worth $50,000 that you bought for $10,000. If you sell and donate the cash, you owe capital gains tax on the $40,000 gain. But if you donate the stock directly, you avoid the capital gains tax entirely and get a deduction for the full $50,000 fair market value. The charity sells the stock tax-free because they're tax exempt. Everyone wins except the IRS. Qualified charitable distributions from IRAs are another powerful tool once you're over 70 and a half. You can transfer up to $100,000 per year directly from your IRA to charity. The distribution counts toward your required minimum distribution but isn't included in your taxable income. This is especially valuable if you don't need the RMD for living expenses. Instead of taking it, paying tax, and then donating, you just send it directly to charity tax-free. Donor-advised funds are useful for bunching charitable deductions. You contribute a large amount to the fund in 1 year, getting a big deduction that year, then grant money from the fund to charities over multiple years. This is valuable if the standard deduction is high and you wouldn't otherwise itemize in most years. You create one big itemizing year with the donor-advised fund contribution, then take the standard deduction in other years. Now let me talk about insurance needs in retirement, which change significantly from your working years. Life insurance, for example, is primarily needed when you have dependents who rely on your income. If you're 65 Your kids are probably grown and self-sufficient. Your spouse might have their own retirement income. The need for large life insurance policies diminishes or disappears entirely. However, some people maintain life insurance in retirement for estate planning purposes. If you have a large estate that will owe estate taxes, life insurance proceeds can provide liquidity to pay those taxes without forcing the sale of illiquid assets. The death benefit is income tax-free to beneficiaries, though it's included in your taxable estate unless the policy is owned by an irrevocable life insurance trust. For most retirees without enormous estates, I'd let term life insurance policies expire once they're no longer needed. Don't convert to expensive permanent policies that drain cash flow. If you need some coverage for final expenses or to help out kids, buy a small permanent policy if necessary. But don't overinsure out of fear or because an insurance agent convinced you that you need it. Disability insurance typically ends when you retire since you're no longer earning income to protect. But long-term care insurance becomes more relevant, though, as I mentioned earlier, it's expensive and has limitations. The decision to buy long-term care insurance depends on your assets, your risk tolerance, and your family situation. If you have $2 million in assets, you can probably self-insure for long-term care costs. Even if you spend $300,000 on a few years of care, you'll still have substantial assets remaining. But if you have $500,000, a prolonged long-term care situation could devastate your finances. That's where insurance might make sense despite the high premiums. The challenge with long-term care insurance is that premiums can increase dramatically over time. Policies sold in the 1990s and 2000s have seen premium increases of 50 to 100% or more as insurance companies realize they underpriced the risk. Many people end up dropping coverage after paying premiums for years because they can't afford the increases, and that's a terrible outcome. My general philosophy on insurance and retirement: insure against catastrophic risks you can't afford to self-insure, but skip insurance for risks you can handle with your existing assets. A wealthy retiree doesn't need extended warranties on appliances or rental car insurance. They can afford to replace a refrigerator or pay for a fender bender. Save premium dollars for the risks that could really hurt you financially. Let me discuss Medicare in more detail because it's complex and choosing wrong can cost you significant money. Medicare eligibility starts at 65. You must enroll in Part A hospital insurance, which is free for most people. Part B, medical insurance, is optional but strongly recommended. It covers doctor visits, outpatient care, and preventive services. The standard premium is about $175 per month, though high earners pay more through income-related adjustments. Original Medicare, Parts A and B, covers about 80% of costs. You're responsible for the other 20% through deductibles, co-pays, and co-insurance. Most people buy supplemental coverage either through Medigap policies or Medicare Advantage plans. Medigap policies work with Original Medicare and cover most or all of your out-of-pocket costs. Medicare Advantage plans, also called Part C, replace Original Medicare with private insurance that often includes drug coverage and extra benefits. Choosing between Medigap and Medicare Advantage is a significant decision. Medigap offers more flexibility. You can see any doctor who accepts Medicare without network restrictions, and your out-of-pocket costs are predictable, but premiums are higher, typically $100 to $300 per month, depending on the plan and your location. Medicare Advantage plans often have low or zero premiums and include prescription drug coverage, but you're limited to network doctors. You might need referrals to see specialists, and out-of-pocket costs can be unpredictable. If you have serious health issues requiring lots of care, you might hit the out-of-pocket maximum, which can be several $1,000s annually. My general advice, if you can afford Medigap premiums and value flexibility and predictability, go with Original Medicare plus a Medigap plan. If budget is tight and you're healthy, Medicare Advantage might save money, but read the fine print carefully. Understand the networks, the prior authorization requirements, and the out-of-pocket maximums. Part D, prescription drug coverage, is crucial. Even if you don't take many medications now, you should enroll when first eligible at 65 to avoid late enrollment penalties. Drug plans vary enormously in premiums, formularies, and pharmacy networks. Compare plans annually during the open enrollment period because your medications and the plans change year to year. One Medicare gotcha to watch out for: income-related monthly adjustment amounts, or IRMA. If your modified adjusted gross income exceeds certain thresholds, you pay surcharges on Part B and Part D premiums. The thresholds are relatively low, about $103,000 for individuals and $206,000 for couples in 2025. The surcharges can add several $100s per month to your premiums. This is where Roth conversions, capital gains, realization, and other tax planning become important. If you're close to an IRMAA threshold, managing your income carefully can save thousands in Medicare premiums. Maybe you spread Roth conversions over multiple years to stay under the threshold. Maybe you harvest capital losses to offset gains. These strategies require planning but can pay off substantially. Now let me address some of the biggest mistakes I see retirees make with their portfolios. The first, which I've mentioned already, is being too conservative too early. People reach 60 or 65 and immediately shift to 70 or 80% bonds because they're scared of stocks. Then they spend the next 30 years watching inflation erode their purchasing power while bond yields barely keep pace. Don't make this mistake. You need equity exposure even in retirement. The second mistake is chasing yield without understanding risk. Retirees need income, so they're attracted to investments with high yields, but high yields usually mean high risk. A stock yielding 8% might look attractive until you realize the company is in financial distress and about to cut its dividend. A bond yielding 10% might be from a company on the verge of bankruptcy. There's no free lunch. High yields compensate for high risk. Be especially wary of exotic investments promising high yields with low risk. Master limited partnerships, business development companies, preferred stocks, high yield bond funds. These all have their place, but they're complex and carry risks that might not be obvious. For most retirees, sticking with high-quality dividend stocks and investment-grade bonds is safer and simpler. The third mistake is market timing. Retirees sometimes think they're sophisticated enough to move in and out of markets, avoiding crashes and capturing gains. They sell stocks after a big run-up, planning to buy back cheaper, or they sell during a crash, planning to buy back when things stabilize. This almost never works. You have to be right twice, when to sell and when to buy back, and most people get at least one decision wrong. I've been investing for 8 decades, and I don't try to time markets. I stay invested in quality businesses through all market conditions. If markets are expensive, fine, I hold what I own. If they crash, even better, I can buy more at discounts. But I never try to predict short-term market movements because it's impossible to do consistently. If I can't do it after 80 years, retirees shouldn't think they can either. The fourth mistake is not adjusting spending during downturns. We talked about flexible withdrawals earlier, but it bears repeating. If you rigidly withdraw the same amount every year regardless of market conditions, you amplify the damage during bear markets. You're forced to sell more shares at depressed prices, permanently reducing your asset base. Better to tighten your belt during tough years, spend less on discretionary items, and give your portfolio room to recover. The fifth mistake is ignoring tax efficiency. Some retirees withdraw money from accounts without considering the tax implications. They take IRA distributions when they're in high tax brackets instead of waiting until lower income years. They sell appreciated stocks in taxable accounts and pay unnecessary capital gains taxes. They don't coordinate Social Security claiming with other income to minimize taxes. All of this costs real money over a retirement. Work with a qualified tax advisor who specializes in retirement tax planning. The money you spend on advice will be more than recouped through tax savings. This isn't about dodging taxes or using aggressive strategies. It's about following the rules intelligently to minimize what you owe while staying fully compliant. The sixth mistake is failing to update plans as circumstances change. Your investment strategy at 65 might not be appropriate at 75 or 85. Your health changes. Your spending patterns change. Tax laws change. Financial markets change. You need to review and adjust periodically. I recommend a comprehensive review at least every 2 to 3 years, more often if major life events occur. Let me share some real-world scenarios I've observed over the years that illustrate these principles. I know a couple who retired at 65 with about $800,000. They were terrified of stocks after living through 2008, so they put 80% into bonds and CDs. At the time, yields were very low, maybe 2 to 3%. They lived on $40,000 per year, supplemented by Social Security. Over the next 15 years, inflation averaged about 3% annually. Their bond income stayed flat while their expenses increased with inflation. By age 80, they were struggling financially. The purchasing power of their savings had declined significantly. They'd spent down assets to maintain their lifestyle, and they faced another potential 10 to 15 years of rising costs. Being too conservative had backfired badly. Contrast that with another couple I know who retired with a similar amount but maintained 50% in stocks through a diversified portfolio of dividend payers and index funds. Yes, they endured market volatility. Their portfolio fell during corrections. But over that same 15-year period, their dividend income grew with inflation. Their portfolio value increased overall. At age 80, they were financially secure with options. The equity exposure, despite the volatility, had preserved their purchasing power. Another scenario, a widow in her 70s with about $1 million, substantial assets, but she was scared of running out of money. She hired a financial advisor who sold her expensive variable annuities with surrender charges and high fees. The annuities paid 5% guaranteed income, which sounded great. But after fees, the net return was mediocre, and she was locked in for years due to surrender penalties. She would have been better off with a simple portfolio of low-cost index funds and bonds. The same income could have been generated with lower fees and more flexibility. But the advisor made large commissions on the annuity sale, so that's what got recommended. This is why I'm so skeptical of high-commission financial products. The incentives are misaligned. The advisor profits, whether the product is right for you or not. Another case, a successful executive who retired with $2 million at 60. He thought he was sophisticated enough to manage his own portfolio actively. He traded frequently, trying to capture short-term movements. He owned dozens of positions, constantly buying and selling. Over 10 years, he underperformed a simple 60-40 stock bond portfolio by 3 to 4% annually because of trading costs, taxes, and poor timing. His activity destroyed wealth rather than creating it. These stories illustrate that successful retirement investing isn't complicated. You don't need exotic strategies or constant activity. You need a sensible asset allocation, low costs, tax efficiency, and discipline to stick with the plan through market cycles. That's it. Complexity usually makes things worse, not better. Let me talk about the emotional and psychological aspects of retirement that impact financial decisions. Retirement is a massive life transition. Your identity shifts from being a productive worker to being retired. Your daily routine changes completely. Your social connections often diminish. This can lead to depression, anxiety, and poor decision making. I've seen retirees make terrible financial decisions because they're bored or lonely or searching for purpose. They day trade because it gives them something to do and makes them feel engaged with markets. They fall for scams because the scammer gives them attention and makes them feel important. They help adult children financially to feel needed, even when it jeopardizes their own security. The solution isn't just financial planning, it's life planning. Before you retire, think carefully about how you'll spend your time. What will give you purpose and meaning? What social connections will you maintain or develop? What hobbies or interests will you pursue? Retirement should be a transition to a new phase of life, not an ending. People with strong non-financial plans for retirement tend to make better financial decisions. They're not sitting around obsessing over their portfolios or falling prey to get-rich-quick schemes. They're engaged in activities they find meaningful. The portfolio is just a tool to support the life they want to live, not an end in itself. Family dynamics also complicate retirement finances. Adult children who need money, grandchildren's college expenses, pressure to help out struggling relatives. These are emotionally charged situations where financial logic often takes a back seat to family loyalty and guilt. My advice, establish clear boundaries before these situations arise. Decide in advance how much you're willing and able to help family members without jeopardizing your own security. Communicate those boundaries clearly. Don't make financial decisions based on guilt or obligation that you'll regret later. It's not selfish to prioritize your own financial security. You can't help anyone if you run out of money and become dependent yourself. Take care of your own needs first, then help others with what's truly surplus to your requirements. This might sound cold, but it's practical wisdom that will serve you well. Let me also address working in retirement, which is increasingly common and can significantly improve financial security. Maybe you don't work full-time at your old career, but you do consulting or part-time work or pursue a passion project that generates some income. Even modest earnings can make a huge difference. Suppose you earn $20,000 per year from part-time work during your 60s. That's $20,000 you don't need to withdraw from your portfolio. Over 10 years, that's $200,000 left to compound. At 7% growth, leaving that money invested could add $400,000 or more to your net worth by your mid-70s. Working a bit longer or part-time in early retirement can dramatically improve your financial picture. There are also non-financial benefits to working in retirement. It provides structure, social connections, mental stimulation, and purpose. Many retirees find that they're happier with some work in their lives than with complete leisure. Just make sure it's work you choose on your own terms, not work you're forced into because you didn't save enough. Now, let me talk about housing decisions in retirement, which can have enormous financial implications. Your home is probably your largest asset. What you do with it matters. Some retirees downsize to reduce expenses and free up equity. Others use reverse mortgages to access equity while staying in place. Others stay put in paid-off homes with minimal housing costs. There's no one right answer, but here are considerations. If you're house rich but cash poor, downsizing might make sense. Sell the big family home, buy something smaller and cheaper, and invest the difference. This can add several $100,000 to your investment portfolio, generating income and providing more financial security. However, moving has costs. Realtor commissions, closing costs, moving expenses. These can easily total 6 to 8% of your home's value. You need to save significantly on housing costs or free up substantial equity to justify these expenses. Moving from a $700,000 house to a $600,000 house might not be worth it after costs. Staying in a paid-off home can be very cost-effective if you're happy there. Property taxes, insurance, and maintenance might total $15,000 to $20,000 per year, far less than rent would cost, and you have housing stability without worrying about landlords or lease terms. The downside is illiquidity. Your equity is tied up in the house and can't generate investment income. Reverse mortgages are controversial. They let you borrow against home equity without selling, with the loan repaid when you die or move. This can provide cash flow while letting you stay in your home. But the fees are high, the interest compounds over time, and your heirs inherit less. I'm generally skeptical of reverse mortgages, except as a last resort for retirees who are house rich but desperate for cash flow. Whatever you decide about housing, factor it into your overall retirement plan. Housing costs, whether mortgage, rent, property taxes, or maintenance, are typically one of the largest retirement expenses. Managing this effectively can significantly impact how long your portfolio lasts. Let me close with some final thoughts on portfolio protection for people over 60. The goal isn't to eliminate all risk. That's impossible and actually creates different risks like inflation risk and longevity risk. The goal is to balance multiple competing risks in a way that gives you the highest probability of financial security throughout retirement. You need to protect against market risk by maintaining a meaningful bond allocation and cash reserves. You need to protect against inflation risk by maintaining equity exposure. You need to protect against longevity risk by not spending too aggressively and letting your portfolio continue growing. You need to protect against healthcare risk by budgeting realistically for medical expenses. You need to protect against tax risk by being strategic about withdrawals and conversions. No single strategy addresses all these risks perfectly. You make trade-offs. More bonds means less inflation protection but more stability. More stocks means more inflation protection but more volatility. Early Social Security claiming means less longevity risk but lower lifetime benefits. Every decision involves trade-offs, and you choose based on your personal circumstances and priorities. The key is being intentional about these choices rather than defaulting to conventional wisdom that might not fit your situation. Think through your specific needs, your risk tolerance, your health, your family situation. Build a plan that makes sense for you, not a generic plan that's supposed to fit everyone. And finally, remember that a retirement portfolio isn't just about the numbers. It's about supporting the life you want to live. The goal isn't to die with the most money. The goal is to maintain financial security while using your resources to create a fulfilling retirement. Don't be so conservative that you sacrifice today's enjoyment for hypothetical future needs. But don't be so aggressive that you risk running out of money. Find the balance that works for you. That's how I'd protect a portfolio at age 60 and beyond. It requires thoughtfulness, discipline, and periodic adjustments. It's not exciting or glamorous, but it works. And working is what matters when you're trying to make your money last for what could be a very long retirement. Focus on the fundamentals, avoid common mistakes, manage costs and taxes, and maintain perspective through market ups and downs. Do that and you give yourself the best possible chance of financial security for life.